Hi, my name is Ben Williams. I'm a broker in El Paso, Texas, and I run a team called the War Team. Every other Friday, we have a session called the Friday Forums. In that session, obviously, we're going to talk about forums that's related to Texas real estate, TREC forums, Texas Realtor forums, and we go deep into these forums and try and keep our agents informed about what's going on. Today, I'm going to jump into the Loan Assumption Addendum. I'm going to explain this in the best way I know how. It's a lot of moving parts with this particular addendum and make sure everybody understands how to use it. If you are interested in learning more about what we do and how we do it, or just want information that we have, reach out to me and let's connect. Okay, let's jump into it. So, when to use this loan assumption addendum, TREC 41.3, TXR 1919, you should use it when there's any assumption of government-backed loans, VA or FHA loans, assumption of conventional loans or private loans, and when you're trying to secure the PACE items, the property assessed clean energy items such as solar panels, water softeners, roof financing, and some of the EV chargers. If you're assuming any of those items, this would be the addendum that you would use to establish that. Now, let's talk about what this loan assumption addendum is not. It is not any form, shape, way whatsoever creates a binding assumption between the buyer and the seller, or the buyer and the lender. It does not bind the lender to accept. It does not replace any lender required assumption agreements or applications. So what does it do? It does establish the expectations and disclosures required between the buyer and the seller about what the buyer is attempting to assume, the estimated loan balance, interest, and payments, any limitations on the assumption fees or interest rates charged, whether the buyer will assume a lien or promissory note, example, the solar panels, water softeners, things of that nature. It does require the buyer to provide credit documentation and gives the buyer and sometimes the seller the right to terminate the contract if certain performances are not met. When you see that loan assumption addendum, people may think this is going to bind this whole thing. It does not do that, because that still has to be established with the investor and the new borrower. So that has to happen that way. But this does put out the measures that has to be met in order to give information to that investor to determine if this is going to really happen. And not all investors and lenders, I should say, I'm just calling investors lenders, not all investors, when you put a loan assumption in, do they approve it? It's got to go through that process. Believe it or not, there's a lot of times where they may prove the assumption, but don't release the liability from the seller. And keep that in mind. That can't happen. The seller could get this approved by their lender, FHA, VA, solar panels, whatever, and that investor may still sit there and say, we'll let this new borrower assume, but we won't release the seller from liability. So there's some cautions there with that. A lot of times it can happen. There's no guarantee that lender is going to allow this to be the end all be all, and the seller goes about their way and there's no liability for the seller. So keep that in mind. So let's jump into this. When is paragraph A not used? When the lender or note holder handles all credit approvals and the seller is released from liability. Paragraph A is all about the credit documentation. And sometimes the lender or note holder will handle all of this. They won't require the seller to do anything because they're going to handle all the documentation, the approval, and release the seller from liability if the assumption is approved. In that case, you wouldn't need to fill out paragraph A, even though I have it filled out here for the example. If the seller is going to be released from liability, then paragraph A is really not needed to fill out in this document. If you're going to do this, have the seller ask the lender if the assumption is proved, am I released from all liability? Is my VA restored? So here's a tip. When helping clients complete the addendum, ask the seller this: will you still be liable for this loan after closing? If they say yes, use paragraph A. If they say no, it's okay to leave blank. Just keep that in mind. Now, if that's the case, you have to fill out. This section is going to ensure the buyer provides credit documentation. It establishes the buyer's creditworthiness. And there's documents that the seller should want. In this case, you're instructing the buyer to provide credit reports, employment status, income verification, bank statements, anything to prove the creditworthiness. You pretty much can ask for it. They leave an actual statement there where you can write in certain things to prove this buyer's creditworthiness. It says sellers must receive within a set number of days to avoid default. I thought 7 days was enough. I feel like if the lender's going to allow the assumption to happen, but they're not going to release the liability, this is something you would want to have set forth for the buyer to evaluate whether to take that risk. This can happen with private lenders too. Let's say the seller financed a second lien or some type of wraparound, and the buyer wants to assume the financing. The note's going to be payable to the seller. Now, the lender, of course, they will want documentation to make sure that it's going to work. So you're going to have those scenarios too. I believe that also with solar panels where the lender doesn't qualify the buyer, that could be another scenario where you're going to fill out Section A as well. When the buyer insists on assuming a loan, but the seller is skeptical, you can require all this documentation. So this is for those scenarios. Any type of broker or agent should always advise a seller to act within the deadline, right? Because if they don't, they'll waive the right to object, right? So you'll see that it's at the very bottom here. Buyer hereby authorized credit reporting to furnish the copies of buyers to seller, and notable the loans will be assumed by the sole expense. And it goes here in paragraph B. If credit documentation described in paragraph A is not delivered to the seller within a specified time, the seller may terminate this contract by notice to the buyer, given at any time before all required documentation is furnished, and the earnest money will be paid to the seller. If the credit documentation is delivered, the seller determines in the seller's sole discretion that the buyer's credit is unacceptable. The seller may terminate the contract by the notice to the buyer within 7 days after expiration of the time delivered or actual delivery, whatever is later, and the earnest money will be refunded to the buyer. If the seller does not terminate the contract within the specified time, seller will be deemed to have proved the buyer's creditworthiness. So these timelines matter. Make sure you advise the seller properly about what that means. If they don't act in a certain amount of time, they are saying that they deem the buyer creditworthiness. So keep that in mind. Let's go to Section C. This is when we're establishing the assumption where the detail of the loan are being assumed, whether it's the first or second lien. In this scenario, made up company SunPower Financing LLC, we're saying the unpaid balance is $18,750. And we're saying that the total monthly payment, including principal and interest and reserve deposit, is $270. This is how you would fill this out. And this is the case of solar panels. This could be used for water softeners. This could be used for any of those PACE items that we mentioned before. And whether it's in first position or second position, this is where you establish whether you use C1 or C2. In the next section, check cash payable at closing. Most likely you're going to see that. If there's any sort of variance, you have to put a cap on the variance. So of that $18,750, we're saying there's a variance of $500. And if so, if there's $500 or less variance, it would be a cash payable at closing. And it says it could be paid by either party, right? In this case, if you look at that, says at closing, either party may terminate the contract and earnest money will be refunded to the buyer unless the other party elects to pay the excess of the variance. Within 7 days after the effective date, seller will deliver copies of the note to be assumed, the deed of trust, and most recent loan statements from the lender. That's really critical as well. So keep that in mind too. I have seen where this has been paid by either party, to be honest with you. Okay. All right, let's go to the next section there, which is these there's to protect the buyer from unfavorable surprises. If the lender raises the interest rate or charges excessive assumption fees, the buyer has the legal right to terminate. In this example, we put caps on the payment of the assumption fee being at $300 and an increase in the rate more than 5.5% being the total cap, 5.5%, then the buyer would be able to terminate and get their earnest money and be out the deal. Paragraph E, consent to note holder. If the lender doesn't approve the assumption, this deal dies. Either party can walk away and the buyer gets the earnest money back. Paragraph F, the seller's lien. If the seller is not released from liability, a vendor's lien will be recorded. I believe always advise the sellers to get the release of liability addendum. It's another addendum that release liability should be filled out if they want to be totally off the hook. It's not automatic that happens, so you need to make sure you advise the seller properly. Taxes and insurance, paragraph G. If there's escrow account, the seller must transfer it to the buyer without deficit, and buyer reimburses the seller. Paragraph H, authorization to release information. This gives permission to all parties to obtain and share documents necessary to approve and close. That's all it really says. And then the notices are pretty important. The notice to the buyer says, okay, look, review the terms carefully, and especially if there's going to be any type of adjustable rate, something like that, you need to make sure that you're responsible for reviewing all that stuff. Notice to seller, you remain liable to pay the note unless formally released from the note holder. That's very clear, which is the next thing. They're advising you what I just talked about, the TREC, release of liability addendum, to get that filled out. And then last here says due on sale notice. Lenders may call the loan due if assumption is not approved. Okay, so keep that in mind too. So when using this form, just make sure you understand the cautions. It can be used for several different reasons, but it has to be associated with assuming a loan. And thank you. I hope this explains a little bit of this form to you.